holidays, so I'll forgive you this time.
I know. We didn't have some hats. We didn't have any props.
What happened to our hats, man? I specifically got us hats for the gifts last week, so we'd have something. We totally botched it.
It's all good. It's all good. But it's a holiday week, right?
Yeah.
Short week for everybody. So thanks for tuning in. What are we doing?
We're talking about real estate.
What show is this?
That's what we talk about all the time. So welcome to Money Mondays, everybody.
Yes.
Every Monday, 3:30 p.m. Central.
We are nothing if not persistent. We are going to do this on the holiday week. Every Monday.
I'll try to go home today. Ben won't let me go home.
No, absolutely not. You got to work, buddy. Somebody's got to put in some time around here. All right, so Money Mondays.
What are we
Thanks for
talking about
tuning in,
today?
folks. We're talking about underwriting, part 2. So I think we're going to do a couple more of these too. So I don't want anybody to feel like, hey, if you missed this one or...
It'll be part 2, 3, 4, 5.
It might need to be.
Underwriting seems to be an important topic.
Well, it's important. It's popular, and it's I would say that there are two things to real estate, right? We talk about this all the time, right? It's a numbers game and it's a relationship game. So we're going to try to we ultimately can't make you a more personable person, but maybe we can help you on the underwriting side to get a little bit more familiar with the numbers and the concepts and kind of the terminology, right? So you can determine, even as a passive investor, what's a good deal, or if you're going to buy a deal, right? What's a good investment? Right?
But for those that are new, what does underwriting mean? Let's start with the basics, right?
So yeah, I mean, I throw around this stuff.
Before we do that, actually, so Money Mondays, every Monday, 3:30 Central, right? If you have questions, comments as we go through this, definitely ask them. We will go through them at the end. Typically, we'll spend about 15-20 minutes presenting, and then we will basically do Q&A at the end. So if you have questions, do not hesitate to ask them.
So underwriting, analysis, analyzing a deal, they're all synonymous, right? So what are we talking about when we say stuff like that, right? It means that you are taking the historical financials, the past financials, you are then putting them into, a spreadsheet that maybe you've developed or maybe you bought from somebody else, and then doing projections from there. Those projections are going to determine, is this deal going to be a good deal, right?
So really, underwriting is a fancy way to say analyzing returns. Right?
Projections of their
Actually, you're analyzing risk, I think is really, because really think about lenders do underwriting, we do underwriting, so it's probably, I wonder what, actually I'm going to look this up right now, define underwriting. So for those in our audience that are too busy, not lazy, too busy to go search for the term underwriting, it means sign and accept liability under, thus guaranteeing payment in case loss or damage occurs.
That's way too sophisticated of a definition, but I think everybody gets it, right? You're looking at past performance to determine, is there something that you can do
so
to
basically
make this
you're
a
really
better
looking at
investment
you're looking at assessing risk. So we assess risk in terms of returns. Other people assess risk in terms of loss, right? So, all right. So before we move on to the slides, right? So basically we have kind of 2 slides to put together. We ran numbers on a deal that we recently looked at, right? The name of the deal is irrelevant. Even the numbers that we're showing are irrelevant, right? What we're trying to do is show people kind of how do you go from financials that you may be given into something that you can make sense of, right? And then on top of that, how do you evaluate? So basically, what are some of the gotchas you need to look at?
Absolutely.
And then how can you evaluate some of that? But before you hop into that, right, let's go through a few comments. Ronnie says, what's up, guys? What's up, Ronnie?
What's up, buddy?
Amanda says, commitment, love it. We are absolutely committed. Ronnie says, this is the most casual I've seen, Ferris. Thanks, I'll take it.
I know,
I told
man,
Ben it was sweater weather. He didn't wear a sweater, man. So
this guy.
Trevor says, thanks for sharing. You're welcome. And Ronnie says, for underwriting, how to mitigate the prepayment penalty for agency debt. Oh boy, that's okay. That's a loaded question. We'll go to that one maybe later.
We'll get to the particulars, right, folks? Once again, you're not going to learn how to underwrite a deal from this 30-minute show, right? There's a lot that goes into this, but we're going to try to give you the high level, how we look at deals, what the assumptions that we make, some of the terms that we use, right? Terminology in the business. I think that's important, right? Because even if you're a passive investor, you're just looking to invest in somebody else's deal, they're going to throw around things, right? What are cash on cash returns and IRR and total returns? You need to understand what this stuff is and how they're calculating it, right? So we'll get into a little bit of it, right? So as Ferris said, the deals are relevant. It was a deal that we ultimately passed on because you'll see why. And this was some of our, a little bit of our underwriting, right? This is like one little snippet of.
So if we take a look,
we have a 13.
So Shannon, if we show them the screen, right? So T12 basically stands for trailing 12. Right. It's what the financials that we were giving. If you sum up all of the past 12 months, right, 1 years of financials, what that looks like. And so you can see, what, just kind of maybe go through this, right? That's the left column. The right column is basically modeling in, okay, if you're purchasing at a $44 million purchase price.
Our assumptions.
And that's actually what the brokers wanted, yes. Yeah. So normalized expenses at a $44 million purchase price, what that looks like. So let's go through this really quickly, right? Average monthly income, right? We did believe that there was some opportunity to push rents, right? And so that's where, you can see we did a little bit of a pop, right?
Yep.
Now, the one thing I want to point out to people, this was a newer asset, right, that basically brand new, so it was in lease up. So the T12 financials, right, they're exaggerated intentionally to showcase this people, right, what to look for, right? But obviously they're not indicative because a property that had 1% occupied versus 100% occupied is very different.
Well,
right?
I mean,
and so that's where if you look at this, the vacancy, right?
That's crazy.
So only if Ben was running a deal would it be 65% occupancy, right? So,
only in a lease up or only in a situation where you have a lot of down units will you ever see vacancy that high, right? We'll give you some rules of thumb, right? Yeah. I'd say CB assets, right? You're anywhere from 5 to 10 is where you're wanting to try to run your vacancy, right? Obviously this is 65, and then we were saying, hey, we're going to continue to lease up, right? Because it's not 100% there, so we will have some vacancy going into our year one. That's why it's at 25%.
Yeah. So. Right? Exactly. And so, this deal was basically stabilizing, right? That's why it was for sale, because they got it back to 90%. For those of you that remember, right, whenever we buy debt, to get the best debt, Fannie, Freddie, right, you want it stabilized. That means 90% occupancy or more for 90 days. So this deal had just reached that, but 8 months ago, whenever they were in lease up, it wasn't there, right? And so if you look at what we're doing, right, we're modeling essentially, burning off the loss to lease, right? And we're still planning to have, really, if you look at it, 25 plus 6, 31% economic vacancy, right? We'll probably be able to do better, but again, you're still burning it all off, right? Because again, a property that was 60% vacant versus 10% vacant are very different characteristics, right? But that's on the income side. I don't want to spend too much time on that. I don't know if you had anything else to add to that, but really, I want people to understand the expense side, because I think expense is more of the.
Let me point out two things, right? So you take your gross, and then you're going to deduct your vacancy and your economic vacancy, right? Then you're going to get that effective rental income, and in this case, we call it effective gross income, EGI, right? Then you're going to add in other income. People always say, well, what's other income? Well, it's fees, right? It could be, you're charging for covered parking, or there's pet rent, or there's late fees, right?
Application fees.
Anything that is not rental income, but the property charges for, is going to be considered other income, right? The reason that we popped it from 140 to 300, once again, it was a direct correlation between where it was at in the T12, which was, vacancy was at 65%, down to 25%, right? So we're going to just have more people that are going to be paying fees, right?
Yeah,
so then you get the total net income from that number.
Absolutely. And one more thing to point out, right, is, in this case, we modeled the T12, right, just to kind of really showcase to people how, hey, the T12 is almost, it's a guiding principle. It's not like it applies one-to-one, right? In this kind of deal, you would have probably looked at a T1 or T2, right, to be a little bit more indicative of the true thing, because, again, the property 8 months ago is very different than the property today. So
And brokers will usually do that. You have to kind of read the fine print when they're doing their deals, or when they're doing their OMs. They'll usually say, we're taking T1, whatever's going to make the deal look the best. They'll take T1 income and T3 expenses, right? Because they're
taking T1 income with T5 other income with T12, and then 3 years ago is taxes.
Just know that most of the time you might be able to get away with T1 or T3 on the income side, but they're always going to take T12 expenses. So, if the broker has done something else, or you're trying to underwrite to T3 expenses, just know that your lender, especially on Fannie and Freddie deals, is not going to go with that. So, you want to talk about expenses, because I'd say it's pretty important.
Yeah, so let's go through the expenses, right? So let's just talk about these one item at a time, right? First one, real estate taxes. Now, real estate taxes, if you notice, we did a big pop, right?
That is a big pop.
Those taxes are probably based on land value or something, it's a huge, huge difference, right, between an asset that just got built and that. But again, typically you're looking at, and again, all of this expenses is market driven, right? So market specific areas, so keep that in mind. Right, but
we have some rules of thumb there on the right,
and even
but those are rules of thumb.
Ignore that.
Very,
I ignore that one for the taxes, because obviously my taxes is really market driven. You want to usually model anywhere from 80 to 95 to 100% of your purchase price times the millage rate, the tax rate, right? So taxes are very unique when we do not. That's an area a lot of people skimp out on, and then they get burned on it. Even us, we model it high, and then you have a year where you actually don't get, you don't get nuked, which is good, and you almost forget about it. And then next year, you're riding high, you're like, oh, shoot, but our taxes just tripled, right? We've had that. But luckily, we had modeled it, I guess, the previous year. It just came in a little bit late.
We had mechanisms in place to obviously protest it too, right?
Yeah.
So it's not like it's a total loss, right? Between Georgia and Texas, there is a way to get it down too, right? Yeah.
And so let's keep going. So insurance, right? This is another one where, again, you can see on the T12, 36,000, right? That's meaningless, right? That's not accurate.
Yeah.
Right. This is a big property, and so again, we modeled it much higher. And typically for insurance, right, you're modeling in $400 to $600. And again, some places like Phoenix is cheaper. Some places like Houston's more expensive. And so it's market driven. But again, you're looking at the rule of thumb as a rule of thumb. It's not the requirement, right? So you can see that, the insurance that we were given from the T12 was really light, right? Continuing on contract services, right? That was really light. And you can see, again, new property, right? Maybe they didn't have landscaping the first couple of years, the first couple of months until they got the grass in, et cetera, right? But again, contract services.
Let's talk about contract services real quick.
What is it?
Right?
Yeah.
So what is it? So contract services, like you said, it's going to be landscaping, it's going to be pest control, it's going to be pool company, maybe it's going to be alarm or security company, right? It's going to be anything that's a contract, folks, right? That's why it's called contract services. And on a newer property like this one, right, you're going to it's going to be maintained fairly well, right? So you might have a little bit more high-end landscaping than a C-class property is going to have, right?
But you may not need security patrol.
You might not need security, but but your pool is going to be a selling feature too. So you're going to make sure you keep that pool nice and clean too. So it's a trade-off, but there are rules of thumb once again that you can kind of use.
We send Ben out to every pool, every property, basically once a month. So make sure Ben's out there. We get him basically a truck full of
that's my fourth
chlorine.
job. My fourth job is being a pool guy. All right,
All right.
So what else we got? We got turnover expense.
And and again, contract services. That one's very in terms of rule of thumbs. That's not a great rule of thumb because it's very market and deal specific. But again, very high level rule of thumb, right? Utilities.
No. Right. We skipped. Let's talk about
turnover. So what is turnover expense, Ben? You want to explain that to people?
So turnover, right? Whenever you're turning a unit, right? When you're gonna hear that quite a bit. It's when somebody moves out, right? Maybe they're forced to move out through some kind of an eviction, or they skipped out in the middle of the night, or in this case, right? This is a nicer property, right? Somebody just moved out and moved to another property somewhere else, or maybe they bought a house, right? You are going to have expense to actually get that unit ready for the next tenant, right? And maybe even on a newer property, maybe you don't have to do a lot of updates, but guess what? You're at least still doing clean. You're most likely doing paint. You're probably gonna have to clean the floors, maybe even replace the floors. There's gonna be something that's gonna happen there, right? And so it was a big red flag that they had 0 in there. So obviously we took and said, hey, that's obviously not correct, or maybe they're booking it somewhere else on the T12, which sometimes happens, right? They'll try to capitalize a lot of that, which means they're gonna put it below the net operating income. I don't want to get into anything too crazy here on this show, but bottom line, that's what a lot of people will try to do just to make their NOI look higher. But we said, no, that's not correct. We're going to have to spend at least $49,000 to actually turn units moving forward. So we plugged a number in there.
Yeah, and again, because again, brand new property, there's no one's moved out yet.
Yeah.
Turnover was 0.
Yeah.
But there will be turnover. So, keep going down. So electric, gas, and water, right? Again, those don't usually change. I think what we did actually on this one is we did do a T3 because, again, the property empty doesn't use much water, which fast forward it does. So,
and the only thing that I would point out on utilities, right, is that if it's an older property and maybe there's a reason why the water is higher, right? Maybe there's plumbing issues, right? So, but once again, this is a newer property. And so they probably are what they are. Just in this case, right? There was a little bit of vacancy.
Who you say you are?
I don't know.
Superstar.
You gotta watch out for this guy.
Keep going.
All right. So we talked about utilities. Usually utilities, trash might be lumped in there as well. Trash could also be a contract service. So you just have to know that each person's T12. We always have a miscellaneous line because the way that we code stuff on our expenses might be different than how somebody else is doing it on theirs. So that's kind of a catch-all of things that maybe they had a category for, but we don't. So we put that in there. That's what miscellaneous is. And I would suggest that everybody do that in their sheet too, because it happens almost every single time, right? You got a management fee, right? Usually that's pretty straightforward. It's based off of the total income that the property takes in.
This is what the management company is taking.
Yeah, in this case,
not asset management.
They're high, right? If we were having disrupt management, our property management company do it, we would run it for 3%, right? So there's a little bit of a savings there, right? And then. Let's see, repairs and maintenance, right? What is that? That is going to be typical things that might break down, right?
Place an HVAC here or there, and again, that's where it gets kind
compressor
of,
goes out, right?
You got to understand if it's capital expense or not, right? But let's just leave it, replacing a doorknob on a turn. Is that a turnover or is not? There's so a lot of times,
some gray area.
There's a lot of gray area. So a lot of times what we like to do is basically look at contracts, look at turnover plus R&M, right? Add those together and then look at that holistically, right? Because,
Absolutely.
Ben may think a doorknob is turnover and I'm like, no, that's repairs and maintenance, right? Or, sheetrock repair that you're fixing during the turnover, right? It's literally a sheetrock repair, but it's a turnover or not. So, that's kind of loose. But again, the rule of thumb for that is actually pretty good one. That one we do look at a lot, in terms of just getting
G&A, general and admin, right? That's administrative costs. You got a postal or postage to mail things out, right? That's an admin cost. You've got copier lease that you have to pay, right?
Software costs.
Software costs, right? So that's going to be another kind of catch-all bucket, right? Where you're going to have some of those other costs that are related just to running a business, folks, right? That's what G&A is, or general/admin. Payroll.
What is payroll, Ben?
Pretty straightforward, right? You got to pay people, right? And that's kind of come up in the news lately, right?
And this is a good one because this is usually a big item, and it's easy to identify if someone's running a property fat or not from this, right?
That's true.
Again, the rule of thumb works pretty well, right? $1,200, $1,240 is about the lowest you're going to get. But if you see a deal, and we've seen these deals, $1,700 payroll. Guess what?
There might be some
opportunity to run it. Or if you see the deals that are $800 payroll, you're like, that's running too skinny. You're going to probably need it a little higher. So that's a good one to kind of keep an eye on.
And there'll be rules of thumb on, how many people you should have inside, how many people you should have outside. You need to talk with your property management company. And once again, some of this is market driven. It's also asset class driven too, right? You might want to have maybe an extra person on that Class A property because you're wanting to have high touch, high customer service, right? Whereas on a Class C, you might be running it a little bit tighter. Or vice versa. There could be all kinds of different variations. You've got to work with your property management company to determine what payroll is, right? But like you said, there is some soft rules of thumb there. Marketing, right?
Yeah, so again, this is a property that was in lease up, right?
Yep.
So
there's
again,
a ton of marketing.
They're doing all they can because they got 300 empty units and they need to get those things filled. And so marketing is crazy at first, right? Then you taper back because instead of trying to fill up 300, you might fill up 20% of the property because you're having 20% people leave, right?
Yep.
And so, marketing, again, that's a pretty good rule of thumb, right? You can see, we're even modeling $300, right?
Yep.
So it's kind of, versus, I don't know what the math is for theirs. I guess it's probably more than double. So, they're probably at $700, right? Mm-hmm. And so it's a good one to kind of, again, get a good sense of it. And last but not least, deposit placement reserves, right? They don't have that.
This is something that you're rarely ever going to see.
You're almost always going to be required.
Yeah, you're always going to have to pop this in, right? And what is this? This is an escrow that, at least on Fannie and Freddie deals, we've seen a couple bridge loans that they don't require this, but most of the time they're gonna make you escrow $250 to upwards of $350 per unit per year into an escrow each year to pay for capital items that might go out throughout the course.
And what is
the
the capital item, just so people don't
know? So, I consider this, so there's R&M like we talked about earlier, right? And then there's capital things, right? A capital item would be the replacement of the roof, right? Whereas an R&M could be you're repairing a couple shingles up on the roof, right? And you got to buy the shingles and you got to buy the nails to put the shingle in there, right?
Yeah.
That's R&M versus capital. So it's a one-time thing that you're not going to be doing on a monthly or even on a yearly basis. And in that case, you can draw from your replacement reserve account through your lender. Right?
Basically, the lender assumes, some stoves are going to go bad, some roofs are going to go bad, everything goes bad. You're going to spend that money regardless, so it's kind of a wash. So you kind of assume, it's an expense item, right?
Yep,
and now you're going to spend and get it back. And maybe you don't spend it all in year one, but year two you'd have twice as much to spend. Who knows?
And one thing that I want to point out too, right? This is a newer deal, but on some deals we do a very, very big rehab, right? So you're going to have a capital bucket too, right? That's going to, on top of your replacement reserve escrow, you're also going to have just maybe $1 or $2 million worth of CapEx funds that you can tap into. Yep. Right? So, you got to bake that into usually year one or maybe even into year two, right?
Yeah.
So what does this all equate to, man?
Yeah, so continuing on, right? Look at total expenses, $1.7 million, right? What I care about is that percentage next to it. Yep. 56%. That's healthy. For a brand new asset, it could probably be lower. But this is in a market where taxes are just naturally high.
Yep.
And so, that feels good versus if that was 45%, or if that was 75%, I'd be concerned, right? Maybe too high and expenses too low.
Yep.
And so overall, it feels about right. And so again, this is what we call, this whole thing that we just talked about the past 20 minutes is what we call normalizing the expenses, right?
Yes, absolutely.
You're normalizing them, you're bringing them to average. Maybe someone's running it piss poor, right? You're using what they're running as guidance, but you're also tying it to kind of, industry norms.
Absolutely.
And so with this deal, the way the broker whisper was, right, $44 million, it's a 4.3% cash on cash, 6.58% IRR. You want to buy this deal, Ben?
So it's a garbage deal.
Whoa. I mean, yeah, so it's not a very good deal.
That's why we're not saying
people, not making much money on this deal.
No, we would not. This is way too tight.
And also maybe one other thing too, this is modeled, I know we modeled it with year 2 and 3 burning off for that, that loss to lease and getting, stabilized occupancy. But yeah, even with all that, it still doesn't work out very well. So then, the next question is, all right, well, what price does it work out at, right? Yep. So that's where you just start dropping your price, which changes your debt service, which improves your cash flow. Yep. So again, changing the price, the income stays the same. The expenses will stay the same too, right? Minus the tax piece. But ultimately, right, for this deal that they wanted $44 million, $35 million is probably the price that works, right? That gets you to above an 8% cash on cash. That gets you to a 13% IRR, which for a new asset is sellable in a good market.
That's definitely doable, right? But you can see, folks, right? They were wanting $44 million. We're kind of buyers at 35, right? So that's
Ben's a cheapo, man. He's a cheapo.
Quite a bit off, right? And we see this more often than not. This is not the exception. This is pretty much what's happening, across 80 or 90% of the deals that we see, right? And the rule of thumb really is if you're within 90, 95% of the ask, you should probably make an offer, right? Obviously, we're going to be a little bit off on this one.
So this deal didn't offer on, but
we did not.
We underwrote it.
But you have to see where we had to kind of adjust a few things too, right? Just to make it work at the end of the day, right? And so 35 million versus 44.
Yeah,
it's pretty far off.
But so that said, Money Mondays we do this every Monday, 3:30 Central. Today we're talking about multifamily underwriting, part 2. Yep. There is a part 1. Go find it on YouTube or Facebook.
Yep.
And basically we'll spend 20 minutes talking about different topics. That's what we're talking about today. And we're kind of we got about 5 more minutes left, so we'll kind of open up to Q&A. Yep. If you have questions, comments, let us know. Or otherwise, we'll wrap up and kind of go through a few more things.
Yeah.
I know. Let's see. Ronnie says property taxes, insurance have gone through the roof these past years. Absolutely, but for insurance reasons, you don't want things going through your roof. Jefferson says, how are you doing, Ferris and Ben?
I love it.
Doing good.
Hey.
Ronnie says, rule of thumb changes by the property type and submarket. Absolutely. Mm-hmm. Amir says, hey guys, when you are trying to underwrite a deal on the fly, what rule of thumb percentage-wise do you use for the GOI, gross income, I'm guessing, to attain the NOI for a Class C deal?
Ooh, okay, so
what do you use? I don't quite understand the question. What rule of thumb do you use for the gross
operating income?
I guess gross operating income to attain. So I mean, long story short, you're looking at the deal where you think it could pop to, right?
And maybe you can't pop at all.
And slap off 55, 60% of that for expenses, market specific, right? Yeah. That's your income, and then look where your debt service lands after that, right? And that kind of ties to your returns. And so
there's back of the napkin analysis, right? Where people, you use what's your rent minus usually at least 10%, and then whatever that comes into, and then you take 55% of that, and that's what your NOI is going to be, right?
The mirror says percentages, boys, 50%, 40%. Of the gross, I mean, I guess ultimately if we're saying 55% on the expenses, that would leave 45% on the income, right? So maybe that's the answer you're looking for. So 40 to 45%, depending on even newer asset, I'd get to 52%, right? So 48% on the income side. But, I don't like looking at it that way as much as I do like looking at the average rents, where I could take rents to, and what price am I buying it per door.
Yeah, start there.
The 1% rule is the easiest rule of thumb to do.
Don't go into it from the other direction. Always start with your income first, guys. That's the easiest way to look at this. And I'd caution the 55 to 60% or whatever. We've seen deals in other states, Phoenix being one, where expenses are a lot lower than they are here in Texas, right? And so that kind of throws out sometimes the 55%.
Yeah.
Rule.
Who knew not having hurricanes around reduces your expenses?
Right? Just because and then the taxes aren't. They're not as aggressive on taxes either, right? So so there's just different rules of thumb. It just depends on where you're wanting to buy a deal, and you really need to talk with the property management companies in that submarket to understand those expenses. Because Georgia, when we went into Georgia, it was different than Texas.
Yeah, Georgia pays taxes 40% of the appraised price. That's good. So
that's great. At least you can underwrite to what it's going to be, right? You're not, it's not just this mythical thing like it is
Ronnie
here in
asks,
Texas.
what's y'all's process on verifying rent comps? CoStar, calling comps, etc.
CoStar,
CoStar, apartments.com, and last but not least, we have a team that will literally call all the properties nearby.
And new deals, we're going and shopping the comps too.
Yeah.
So that's literally me and Ferris. We do that along with our team. because I want to see not only what rents are they charging, but what's the condition of the comps too, right? You know, what amenities do they have versus us, right? Maybe there's a reason why they're getting $100 more, right?
We walk in and pretend like we're going to rent, right?
Yeah.
We'll say Ben.
We literally did that.
Ben's a new hair model moving into the property, you know. And,
it's not weird, guys,
and I'm the computer guy.
We're just all friends, right? You know, and ultimately you just ask questions,
yep.
right? And most of the time the leasing agents, they're going to be happy to talk to you, you know, and they're going to tell you everything you need to know about the property, right? So that's the way to verify that. CoStar is
very loose, yeah.
Yeah, it's a little
If anyone has any more comments, questions, let us know. We're happy to kind of answer them.
What else we got?
Let's keep going.
So open Q&A. All right. So we do have a course here.
Yeah. So for those of you who know, we have investoracademy.net that we launched, right?
We're shamelessly plugging something.
Yeah.
You know,
and it's really more about, we spent a lot of time just putting these videos together just because we get asked this stuff a lot. So we figured we'd put it together in a nice collection for people to go watch. So
you're gonna say the URL on this one.
It's www.investoracademy.net/products/multifamily-real-estate-underwriting-masterclass. All right. But next time we're going to simplify that one. It's going to future. It'll be a lot simpler. Shanna gave us a thumbs up, so we're going to make that a simpler.
So what's the discount code?
But go to investoracademy.net and you can find it. It's only a handful of courses on there. Discount code DISRUPT. Right, give you 30% off.
So this is, we poured hours into this, folks. We really took a deeper dive into all of these concepts and went through some mock deals, so you really can get a better sense for it. Like I said, we're not going to be able to go through it all on this 30-minute show, right? You know, but we we will have we like
many hours into that one.
You know.
And last but not least, we have our big conference coming up.
It's
so
coming up.
T-minus 2 months, Ben.
I know. Man, can you believe it?
Yeah. A little bit more than 2 months.
We've had a lot of demand for these tickets. I was pleasantly surprised.
No,
we're
selling out much more quickly than expected. So if you are interested, check it out sooner than later.
So what's the deal? We got a buy one, get one, $150 off. Are we making any money on this thing?
We don't make money on this thing.
Jeez,
so this is a break-even thing. So, but
we might be losing money on this.
It's more about putting people together, building an environment, right? That's where we find people, we find partners, you find everything. Yeah. Who did we have? Tell me more about who did we have at the last one? What was the last one about?
We had the mayor of Houston, Mr. Sylvester Turner, last time.
Came out, and who else did we have out there?
We had Mr. Neil Bawa. We had Rod on that one.
out there. We had a whole shebang, and so it's basically a one-day crash course with the who's who of multifamily. Yep. No sales pitch, no nothing. It's purely about content and networking. That's really the pitch.
Yeah, and we really do it for the networking component too. So we try to introduce that throughout the day, and obviously we're pretty laid back guys. So no sales pitch.
Ben needs more people to talk to, so we go do this whole conference.
I'm just drinking my coffee. We literally have the Starbucks on right next to the conference.
No, it's a requirement because they're talking about moving us to a bigger room because last year we had 400 people. They're talking about putting us in a bigger room, and I'm like, are you guys going to move the Starbucks to our floor? And she didn't like that comment at the hotel.
If they don't have that, then the deal's off.
Yeah.
Right. So go check us out, mfinvestornetwork.com. Put in the or go through the holiday sale.
Buy one get one, $150
off. I guess you don't have to have any
Yeah.
coupon code, right, Shanna? You just go ahead. Just go through it and it'll automatically deduct it. So
awesome.
You're good to go. But we're gonna.
With that said, it's 4 o'clock.
Enjoy the holiday week, everybody. Be safe. Enjoy it with your friends and family.
If anyone has any more comments, questions, let us know.
Well, no, before we go, so because of the holidays, we're going to come back to you on January 4th. We're going to put our, whichever one has been viewed the most, we'll put on next week because it's obviously popular, right?
Put it on? What do you mean?
We'll just restream it, right?
Maybe. We'll see.
Why not?
We'll see.
Why not?
It'll confuse people. They'll be like, why aren't you talking about the holidays? You're talking about Halloween, and that was 2 months ago. Who knows?
Oh, come on. We're not going to do the one with the Halloween mask.
Ben wants to take some time off. I'm like, we should do it. He's like, no.
I thought we were going to take some time off this week.
We figured, people are going to be busy. We don't want people dropping, and stop spending time with their families just to watch us. We know people would, but we figured, people should spend time with their families instead. So with that said, we'll skip next week, but we'll be back the week after.
So we'll see you back January 4th, everybody. We appreciate it.
All right, let's call it a wrap.